A splendid evening it is to viewers. Welcome to Equity News and Equity Access, your business and economic insights in Zimbabwe and beyond. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's roll. State-owned telco giant Net1 reported a profit of $10 million for the year 2018. This comes on the back of a negative performance in 2017 at a loss of $77 million. Revenue scaled 13% to $120 million from $106 million reported in the year 2017. This was indicated during a post-AGM briefing held in the capital this morning as the chief executive, Mr. Muchenje, gave perspective into the figures. Our Equity Access team was on the ground. Let's have a look.
The year 2018 witnessed the resurgence of Net1 as the leading network of choice in Zimbabwe, with a historic $88 million turnaround from a loss situation of $77 million in 2017 to a profit of $10 million in 2018. Our EBITDA, which is our operating profit, or we can call it a proxy for cash generated from operations, grew from $15 million in 2017 to $38 million in 2018, which translates to a growth of 153% in our operating profit or cash generated from operations. In addition, Net1 realized a revenue of $119 million, representing a 13% growth year on year. Ladies and gentlemen, we achieved this on the back of cost containment initiatives, which comprise of enhanced efficiency as well as cost discipline. This is evidenced by the 21% decrease in the overheads to the end of the year, which stood at 48% overheads to turnover vis-a-vis the prior year when our overheads were 69% of our revenues. As a company, we took the conscious decision to adopt a back-to-basics approach, which was premised on 4 key strategic pillars. These are quality network, quality distribution, a quality contact center, and a quality balance sheet.
Now let's take a deep dive into the stats of Net1. I think these are quite interesting statistics if we have a look at them. Now, this would be a historical perspective of how Net1 has performed over the past few years, moving right from the full year of 2014 right up until 2018. A series of perennial losses between 2014 and 2016. In 2014, they posted a loss of $12.7 million. In 2015, a loss of 2.5. 2016, a loss of 2.7. Now, 2017 widening to a loss of $77 million. And then now in 2018, they're back from this red position into the black, posting a profit of $10.27 million. This is a little shy of how Econet, Zimbabwe's largest telco giant, has actually performed, posting a profit of $11 million. So pretty competitive stats that we've actually got in there. Now you look at the revenue performance right from 2014, it's been quite interesting, not so much of a discernible trend. In 2014, $104 million, 2015 $114 million, 2016 $115, 2017 deeping $105, and then now at $120 million. Furthermore, of interest would be the fact that their subscribers over the period grew by 5% to 1.4 million from 1.3 in 2017. Data contribution to revenue firmed 26% to 37%, indicative of shifting consumer needs and preferences. Mobile money registered subscriber growth of 188% to 2.2 million from the 746,000 that they reported in 2017. Net1's mobile money platform One Money market share grew to 2.5% in 2018, witnessing the registration of 1.2 million subscribers. The growth was driven by much of cost containment on the part on the part of Net1. Net1 now is set to be privatized alongside Tel1, a fixed telco giant which is run by the government, in a bid, of course, by government to actually shake things up and see efficiency in these two telco giants. Net1 is also looking to diversify into the entertainment space. Well, a lot of interesting developments. Let's just have a look once again at that AGM and listen to Mr. Michenje shed more light on privatization as well as their move into entertainment. Let's have a look.
To ensure that we succeed and we continue to grow. We are also diversifying our business model. We are going to start this year to provide media and entertainment services, as this is one of the key battlegrounds for Net1. What this means is that once you've got your internet, you've done your WhatsApps, you'll be able to consume some content that we've either generated or we've purchased from content providers for the benefit of our, in order to ensure that we succeed and we continue to grow. We are also diversifying our business model. We are going to start this year to provide media and entertainment services, as this is one of the key battlegrounds for Net1. What this means is that once you've got your internet, you've done your WhatsApps, you'll be able to consume some content that we've either generated or we've purchased from content providers for the benefit of our, in order to ensure that we succeed.
Of course, I did mention how that their performance is pretty much close to that of Econet at $11 million. Well, what has actually seen a reduction in the profit for Econet are basically two issues. First and prime would be the fact that they've actually reported exchange rate losses. Then secondly, it has to do with the unbundling of Econet, and now we have Cassava, which has gone on to be a heavyweight on the Zimbabwe Stock Exchange. As we make progress, Zimbabwe needs $33.8 billion in infrastructure investment between now and 2030. This is according to an Zimbabwe infrastructure report released by the African Development Bank. Now, in the report is the fact that in terms of water supply, Zimbabwe would require $3.67 billion for capital works and related technical support, while the power program would require $1.14 billion. That's your ZESA and power utility services. Communication sector is said to require about $400 million. As we make progress, EDGARS released a trading update for the first 5 months of 2019. Over the period, their profit after tax scaled 570% to 8.7 million Zimbabwean dollars against the $1.3 million in the comparative period of 2018. EBITDA increasing 524% to 16.3 million Zimbabwean dollars. Turnover was up 690% on last year's performance, but unit sales decreased by 16%. Now, there's also been a recent improvement where the Jet brand is concerned, which saw a positive growth of 6% in the month of April, 10% in the month of May, while across the board there's actually been a 6% growth in that Jet brand. June turnover was trending 200% against the prior performance until the announcement of statutory instrument 142. This, of course, is according to the trading update. But for historical perspective, let's get into the stats to look at how EDGARS has performed in recent years right up to this point. Now, this, of course, would be 2014, moving right up until 2018. In terms of the revenue, I'll start with revenue here because there is actually a discernible trend. The revenue was dipping between 2014 and 2016 from $73 million in 2014 right to $52 million. Ever since, they've actually moved in an upward trajectory. 64 in 2017 up until 78.1 in 2018. Interesting to note is the fact that their profit after tax has also moved in a positive pattern. 2016 at just $500,000 there, 2017 $4.1 million, 2018 $8.5 million. This, of course, would be the historical perspective of how EDGARS has actually performed to this point. It remains to be seen how things play out in that sector, as there's actually been a bit of competition in that field there. Of course, Truworths and all those brands coming into that space. Let's see how the story develops. Meanwhile, London Stock Exchange listed Cambria Africa parent to Paynet Zimbabwe, share price tumbled by 30% to 93 cents per share. From 93 cents per share to 65 cents per share amid a payment stalemate with local banks in Zimbabwe. I'm sure we reported on this just a few weeks back, as there's actually a debt to the amount of about $470,000 that is owed to Paynet actually by the local bank. So that is actually seen a bit of a lack of confidence on the part of the investors, resulting in a share tumble. It remains to be seen how the story actually develops. Well, this concludes our evening news bulletin. Up next is a look at the stock markets in Market Daily. Don't go anywhere.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe with a complete range of activities, including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
Good evening, ladies and gentlemen. Welcome to Markets Daily. My name is Anis Shumbumu, and I am your host for tonight with no representative. Actually, let's just jump into the markets today quickly. We have witnessed a CISO movement now on the stock exchange, with the stock exchange rebounding from prior session losses, coming up 0.48%. And the industrials index adding 0.49% to its point level yesterday, settling at 635.72 points. Now, the top 10 index has gone up 0.79% for it to settle at 182.14 points, pretty much extending its year-to-date gains to 25.61%, which shows somewhat of a movement more likely on the side of mid-tier to low-tier stocks, pretty much dominating the market at the current moment, because we do realize that the year-to-date gains for the all-share and the industrial index are much more superior than the top 10 index, even though most of the movements in the current state right now do seem to be dictated by some of these heavy counters, much of which would be coming from Econet Delta and Cassava. But then today, Econet and Delta did extend its prior session losses, letting up 1.22% from its share price for it to settle at 168.98 cents, and Delta settled at 350.25 cents after having shed off 0.01% today. Now, InScore being another counter that has got some that has a good amount in terms of market capitalization share, it did let up 0.02%, while Old Mutual has continued on its upward trend at the current moment, coming up moving up 2.05% for it to be 87.87% ahead of its year opening price. Now for our 5-day trend, the minings index is at a comfortable 0.19% ahead of its prior of last week Wednesday's performance of 248.5 points. Now the All-Share Index is now in the positive, so are the other two indices as they are 0.96%, or the All-Share Index ahead of last Wednesday's performance. Industrials Index is 0.97%, and the Top 10 Index is 2% ahead of last week's performance. Like I did mention that on a year-to-date basis, we do realize that the most of the movements are coming from mid-tier to low-tier counters there. But in the most recent weeks, we have an evidence of the top 10 index showing some dominance in terms of the movement of the stock market, with its 2% gain there that was shown just earlier on. Now we had about 14 counters that exchanged hands on the stock exchange today. 4 were risers and 5 were laggards, leaving the remainder to be stable. Axia was the worst performing counter after having settled at 50 cents, having dropped about 7.41% on its share price, while Econet and African Sun did trail that, coming off 1.22% and 0.12%. InSquare and Delta, we've already touched on those, while Cassava was the only of the top 3 counters, the top 3 counters in terms of market share, having gone up 3.41% for it to settle at 169.6 cents. Now Cassava has been a very innovative group of companies where you would find that a lot of applications are coming in from that business, which then does spare the performance of Econet because of the synergy that they have in terms of Econet being able to leverage their data services of Cassava's applications and products that they do serve. Now, Old Mutual, I'd like to believe that there is somewhat of a movement for investors who still feel that even though there's a 90-day vesting period, they would still need to move out of the market of Zimbabwe, as we do realize that most of the industrial areas in Zimbabwe currently are very much hung up by these ZESA issues that we are facing in the nation currently, that would pretty much pull down most of the productivity for most of these counters on the ZEC, which should effectively affect their earnings by the year end if this problem continues and persists without any solutions that do bring any light at the end of the tunnel. OK and BAT did kept the riser set, coming up 0.28% and 0.1%. For BAT to settle at 3,953.91 cents. Now, EDGARS did issue out a trading update today. EDGARS did mention that they did enjoy a 526% increment in terms of the EBITDA after having enjoyed a 90% increase in their turnovers. Now, some of which has come from a position where most of their prices have been going up in line with inflationary trends in the country currently, but they did mention that in terms of their cost containment, they have managed to keep their inflation in terms of cost pretty much trailing behind the top line inflation movements. So that has given them some breath in terms of their performance there. Now their cost, the inflation rate was at 97%, and their turnover went up 90% by the end of May. So that should show us that these guys have tried to keep themselves very much close to what inflation trends have been doing. Now, consequent to their inflationary movements in terms of their prices, their unit sales have come off about 16%, but then that 16% decline has been offset by the price increments, causing for them to be able to perform in such a delightful manner in the current season that they have actually reported on. Moving on to our forex markets, we have consolidated somewhat of a closer convergence between the interbank rate and the parallel market rate, as the parallel market rate did come off today, selling at 9.8, while the interbank rate has weakened further. But then today it was much more of a significant movement from its prior session movements, where yesterday it had traded around about 8.68 to the dollar, and today has traded about 8.76 to the dollar, according to the RBZ. Now, some of these rates that we do mention are pretty much informed on the basis of a lot of data collation and averaging. So some of these rates may not really reflect what you may have seen, but the RBZ has its own rates. But then most banks at the current moment are trading pretty much closer to what the parallel market is doing, for them to be able to be still very much competitive, and as well for them to keep on driving their agendas of being able to amass a lot of foreign currency. But something of note, which may be very worrying, is that the bid price has been moving slower than the ask price, which shows that these guys are really looking to make sure that they amass a lot of foreign currency, yet they're not really releasing much of that foreign currency. Yes, some trade laws do mention that, and of which one of these trade laws are set within our own laws within Zimbabwe, that banks should trade the same amount of foreign currency that they trade by in the beginning of the day should have been closed off by the end of the day. So some of these trades are not being totally completed, and this has pretty much caused for some of the price increments that we are seeing from the interbank rates, and the much justified somewhat of a convergence between the parallel market and the interbank rates. Now, from me and the Equity Access team, we do thank you for viewing us this evening. Please do not forget to like, follow, and subscribe our YouTube, Twitter, and Facebook accounts at Equity Access. Don't forget to visit our website that is full of full of bright and very insightful news at www.equityaccess.net. Thank you.